In the last video, I showed you a financial trick so large, so brazen, and so widely accepted that Wall Street analysts write about it in research notes as if it is. The wealth blueprint. It's perfectly normal, big tech companies paying each other for AI services creating the appearance of real, while the actual money just circles between the same handful of corporations. But here is what I did not tell you. Where does that money actually come from in the first place? Because circular financing only works if someone is injecting real capital into the system. Someone has to be the source. Someone has to be the one taking the actual risk. And when I traced that money TAM all the way back to its origin, Japan, what I found was not just surprising, it was alarming. Because the people taking the most risk in the AI boom are not the billionaire tech founders. They are not the hedge funds or the venture capitalists. The people taking the most risk are people who will never watch a single YouTube video about investing. And one of our might be Yuko, without you even knowing it. My name is Nana. This is the wealth blueprint. Before we go further, let me quickly anchor this for anyone who missed video 1 and wealth blueprint. And today, we are following the money all the way to the source. If you have not seen it yet, I will link it above. Here is the core. Microsoft invested $10 billion into OpenAI. OpenAI uses Microsoft's Azure cloud services, paying Microsoft billions back. Amazon invested $4 billion into Anthropic. Anthropic runs on Amazon Web Services, paying Amazon back. Google invested in Anthropic too. Anthropic uses Google Cloud. The money goes out, and the money comes back. That is circular financing. The result is that these companies can report enormous AI revenue that looks real, that shows up in earnings calls, that drives stock prices, but a significant portion of it is money that originated inside the same art. It is not lying exactly, but it is not what most investors think it is either. Now, the question I want to answer today is, where did that 10 billion, that 4 billion, that 50 billion, where did all of that original investment money come from? Follow me. The first and most visible source is venture capital and private equity. In 2023 and 2024, VC firms poured over $200 billion into AI startups globally: Sequoia, Andreessen Horowitz, and SoftBank. SoftBank, Tiger Global, the biggest names in private investing, placed enormous bets on AI. Now, VC money is supposed to be high-risk capital. These investors know they might lose everything. That is the nature of the game, and many of these firms have built-in protections: preferred shares, liquidation preferences, board seats. If things go wrong, they are not the last in line. But here is the problem with VC at this scale. The money has to come from somewhere. VC funds raise capital from their own investors, called limited partners. And who are the limited partners? Limited partners of the biggest VC funds, university endowments, family offices, and increasingly pension funds, which means the risk does not stay with the billionaires, it filters down. This brings me to the second hidden source, and the one that concerns me most as an analyst, sovereign wealth funds and pension funds. In 2024 and 2025, sovereign wealth funds from Saudi Arabia, Abu Dhabi, Singapore, and Norway collectively committed over $300 billion to and technology infrastructure. These are national funds, money belonging to entire countries, and increasingly, they are going directly into AI companies, data centers, and semiconductor manufacturing. Pension funds in the United States, Canada, and Europe have also dramatically increased their AI exposure, both through direct investments and through their VC fund allocations. The California Public Employees Retirement System, the Canada Pension Plan, the Dutch ABP Fund, these are funds. Ordinary people, teachers, nurses, civil servants depend on for their retirement. None of these people chose to invest in AI. They did not watch a video, read a white paper, or decide that Anthropic deserved a bet. Their fund managers made that decision and are. If the AI bubble corrects sharply, the people who will feel it are not the insiders, they are the last link in the chain. The third source is the one that keeps credit analysts up at night. Corporate debt. Building AI infrastructure is extraordinarily expensive. The data centers, the GPUs, the energy infrastructure, we are talking about hundreds of billions of dollars in capital expenditure. And a significant portion of that is being financed not with equity, not with cash on hand, but with debt. Corporate bonds, bank loans, leveraged finance. Microsoft, Google, Amazon, and Meta have collectively issued hundreds of billions in bonds. Over the last 3 years, their balance sheets are strong enough to absorb this. And for now, but the AI startups underneath them, the ones that depend on continued investment to keep the circular financing loop running, many of them are not profitable. They are burning cash, and they are borrowing to survive while they wait for the market to materialize. Debt is not inherently dangerous, but debt at this scale, funding an industry that has not yet proven it can generate sustainable external revenue, that is the definition of systemic risk. Let's draw a parallel here, not to scare you, but because history is the most honest teacher we have. In 1999 and 2000, the internet boom had the same 3-layer funding structure. Venture capital poured in, institutional investors followed, and corporations borrowed heavily to build out fiber optic infrastructure that they believed the internet would need. Cisco, Lucent, Nortel, they borrowed billions to lay cable that took a decade to actually fill with traffic. When the bubble burst, 3 things happened in order. First, VC-backed startups failed and LP returns collapsed. Second, pension funds that were overexposed faced significant losses. They had loaded up on tech, took massive hits. The NASDAQ dropped 80% from peak to trough. Third, the debt remained. Companies that had borrowed to build internet infrastructure spent the next decade paying off loans on assets worth a fraction of what they once were. But here is the part of the dot-com story that nobody tells: the infrastructure they built. The fiber, the servers, the protocols, it did eventually become the backbone of the modern internet. The more technology was real, the timing was just catastrophically wrong for investors who bought in at the peak. AI may follow the same pattern. The technology is real, the applications will materialize, but the question for investors is never whether the technology works. The question is whether you bought in before or after the correction. So how do you know? How do you know when the AI funding cycle is about to break? I track one signal above everything else: external revenue growth versus internal capital expenditure growth, right now. The big tech companies are spending more on AI infrastructure every quarter. CapEx is growing at 40 to 60% year over year if external AI revenue from customers, the model is sustainable. The loop creates a seamless cycle that grows faster than the initial investment, demonstrating scalability. It has enough real money flowing in to justify the spending, but if CapEx keeps growing while external revenue plateaus or grows more slowly, the math breaks. Companies start to question whether the return on investment justifies the spending. VC firms slow down new commitments, the circular.
Loop starts losing pressure, and that is when corrections happen, not gradually, but in steps.
Watch the quarterly earnings calls. Watch the CapEx guidance. Watch what happens when one of the big Four blinks first and cuts their AI investment forecast. That is your signal. Here is my takeaway for you if you are invested in AI stocks right now. And the data says most retail investors who have touched the stock market in the past have had a tough time. The last 2 years have some AI exposure. You need to understand what you are actually holding. You are not just owning a piece of a technology, you are participating in a funding. An ecosystem that has 3 hidden layers of risk underneath it. That does not mean you should sell everything and sit in cash. It means you need a framework, a way to tell.
Yeah.
You need a framework, a strategy, a solid plan, a shield against uncertainty. Which AI companies have real external revenue? Which ones are surviving on circular financing? And which ones have the debt capacity to weather a correction? That framework is exactly what I need. The female character continues speaking seamlessly. A static camera shot of the female character sitting on a chair with a serious analytical expression. Any AI company, real versus hype, so you can make decisions based on data, not headlines.
And if you want the full framework before the next video drops, the link to intelligent cryptocurrency
VIP is in the description. That is where I go deeper. Real analysis, real signals, updated. Regularly, check it out, subscribe if you have not already. I will see you in video #3.